In this presentation, we will calculate some ratios related to market perspective. The information and the data will be on the left-hand side. We're going to put that information into the blue area on the right-hand side. The data on the left-hand side is how we would recommend setting up the data within Excel when working through any Excel problem, if possible. Having the data to the left or up to the top of the problem, having the text in a separate cell as the numbers so that we can refer to those numbers with cell references. That's the most efficient way to go forward. What we have here, of course, is the balance sheet for A and B. We can think of them as two different companies. Then we have the income statement for A and B, and we have some prior year data which may be needed within our ratio analysis. So we're going to take a look at two market perspective ratios. One will be the price earning ratio and the dividend yields. We'll start off with the price earning ratio. Price earning ratio, we're going to start off with the market price per share. So the market price per share. And we're going to say that the market price per share is going to be given to us in the data down below. Note that the market price per share will not be on the financial statements. The financial statements don't tell us what the market price is telling us. Obviously, the market price you would think would be related in some way to the financial data because the financial data gives the performance, and therefore the market price might be based in some way on the performance. However, again, market price is something that will have to get outside of the general financial data because it's going to be dependent on the free market. However, of course, the market should tell us a good idea of or some perspective on the well-being of the company in the eyes of investors. So we're going to say that this is going to be 100. I'm going to say equals, pull that from our market information down below. We're going to compare that to the earnings per share. So we want to compare that to the earnings per share. Now, the earnings per share is something that we can calculate basically with the financial statements. We want to pick up the earnings per share number. In our case, the earnings per share is given here. Note it's calculated as the net income divided by B12 over 5. And if you go to B12, we have the common stock divided by 5 because that's the par value. In other words, simplified earnings per share or the simple earnings per share type calculation, it's going to take the number of earnings we have here. Here's the earnings we have, the net income. We're going to divide that by the number of shares that are outstanding. Now, if you go up top to the financial statements and you see this item, you're going to say, okay, there's 170,000 in common stock. If there's a common par value, that means that those are all valued at the same amount, in this case, $5. So in other words, we can take that 170,000 divided by 5 and say, okay, there's 34,000 shares out there. Then we can take our 164,508 divided by the 34,000 shares, and that's going to give us our 4.84 about, and notice that we're always dealing with rounding here. So that's going to be the earnings per share calculation. We're going to say that this is equal to the earnings per share with this information. And then that's going to give us the price earnings ratio. The price earnings ratio then being equal to the $100 divided by the 4.84 or the 20.7. Now let's do the same thing for B. We're going to say this is going to be A and B data. And so we're going to say for B, we're going to say that the market share, and again, this is going to be coming from the market, is going to be $100. $100. We're going to say the earnings per share then. Earnings per share is going to be the 5.18. And then if we divide those two out, we're going to say here's the $100 that we are paying divided by the earnings per share, or the 518. When considering this ratio, note that the market price is basically what we would think about what we would pay for the shares, and the earnings per share are what we're thinking the income, or the basically kind of the return on it. Not that the dividends would be paid out for the earnings per share, but that's how much earnings is happening. That's what you would think that the value to the share on a yearly basic basis would be. So this is going to be the earnings per share dividing the net income divided by the common stock. This is the cost of the shares of common stock. And so therefore you're trying to say, well, here's the price of the common stock. How many times over is the price of the common stock in compared to the earnings per share that we're buying? So per $100 share, what are the earnings per that $100 shares? And then you would say, okay, it's going to take 20 times, 20.7 times that earnings basically to get to the market price. This one it's going to be taking only the 19.3 earnings to get to basically the market price. So in this case, B, you would think would be better from an investment type standpoint. Next, we'll take a look at the dividend yield. So the dividend yield, we're going to start off with the annual cash dividends per share. And this is going to be equal to, if we scroll down to our data, we have the 3.75 cash dividends per share. Now note, annual cash dividends per share, similar type of idea, similar type of calculation. We'd have to take a look at the dividends that were given during the year, and we can divide that out by the number of shares that are outstanding in the year to get the annual cash dividends per year. Now we're going to compare the dividends to the market price. So we're going to say that, compare that to the market price, and that's going to be equal to the $100. Once again, that's going to be the market price, not on the financial statements. That's what the current share is selling for. So you're saying each share selling for $100 on a market, and therefore we'll calculate the dividend yield as being equal to the 3.75 divided by the 100, or 3.8. We'll do that for B now. For B, it's going to be equal to the annual cash dividends per share. Annual cash dividends per share is going to be the 3.98. And remember, the cash dividends is what's actually being paid back. So we're imagining the investor put money into the company, into buying common stocks. They're getting paid back on the earnings of the company that are decided to be paid out in the form of dividends. So we looked at last time the earnings per share. Those earnings per share aren't necessarily given out in terms of dividends. This is the earnings per share that you would think the value of the stock would go up and possibly could have dividends up to that amount, possibly, typically, or we could hold on to that. The company could hold on to that and distribute some other amount, whatever they decide to distribute, in the form of dividends. These are the dividends that were actually distributed, 3.98 per share. We're going to compare that to the $100, $100 being the market price being determined, of course, by the market. And we're going to be comparing the 3.98 divided by the $100 market price. In this case, we're showing what's actually being paid back, what we're actually getting on the investment, what actually got paid back as compared to the market price, which is what it would cost to invest. So it would cost the $100 to invest. And we're not taking a look again at the earnings per share, basically the increase in the earnings of the company per share, but what was actually given out in terms of dividends. So this is actually the return that was gotten in the prior year that was actually handed out per stock. So the 3.79 actual return versus, or compared to, or on the ratio of, divided by the $100 market price. So in this case, we would want the higher dividend yield, and once again, B is looking better here because that means that we're getting a higher return on the investment in terms of the dividends as compared to the market price, what would be paid for that share of stock.